Private credit is getting a ton of interest and headlines these days. And as a pioneer and leader in credit investing over the last 50 years, Lord Abbett has continued to evolve how we approach this space, from dedicated private credit strategies to solutions that blend public and private markets to deliver specific outcomes. We think this evolution is creating some compelling opportunities for investors. But as always, it's important to separate the sound approaches from the noise. That's the conversation we're having today. I'm Brian Forster, and welcome to the Active Investor Podcast. I'm pleased to be joined today by Steve Rocco, who's co-head of fixed income and a partner and portfolio manager here at Lord Abbett. Steve, great to have you.
Thank you, Brian. Excited to be here.
Great. So we have a lot to cover today, but maybe we'll just start with the macro, kind of thinking about how you're looking at just the overall fixed income environment today and credit.
Sure. So I think it's a great time in the credit markets, a very good time to take appropriate risk because spreads are tight, but you can construct portfolios that give you a really attractive carry or risk-adjusted return. So we're very bullish on the credit markets. We see in the near term growth accelerating off of low in Q4, and we see inflation coming down. That is a Goldilocks type of environment, which supports carry instruments. So the asset classes that we like are asset classes like high yield, like bank loans, like private credit, that offer that carry that provides great ballast in portfolios.
Okay. So let's talk a little bit more about this whole idea of convergence. And Greg Benz was here
Sure.
last year just talking about that, and he certainly works in a portfolio with you that blends public and private credit. Just how are you thinking about that dynamic of sort of more blurred lines between the public and private markets and kind of how that can help investors?
Sure. So at the end of the day, I think of, credit as credit. Clearly, post the financial crisis, that was the rise of private credit. That asset class has grown as banks stepped aside. And now, in this environment, you have banks coming back. So you have a push-pull depending on the vol environment between, let's say, broadly syndicated market and private credit. As an active investor, we want to be able to access both sides of that trade. So just to give a recent example, you've seen broadly syndicated spreads tighten. That can make private credit attractive. It also could take away, supply from private credit, bring it into the broadly syndicated market. Those are credits that we may know on the private side. They're credits we may on the public side that go on the private side. So I think having both of that, kind of covered at one firm and one investment department is very important.
Mm-hmm. So I know you manage a portfolio now that sort of leverages the best of both public and private markets. It's also a portfolio you could argue sort of is in that core plus space. And a lot of investors still kind of think back to the experience in 2022, when they sort of had asymmetrical risk and it kind of crept up and caught them in, double-digit losses in sort of intermediate-term bonds. This portfolio you're managing might sort of neutralize some of that risk. Maybe just talk a little bit about how that portfolio works.
Sure. So I don't think investors are getting paid for duration volatility. I think you mentioned 2022, and I think investors kind of woke up to, that rising rate environment after 40 good years. And so what I said up front is, an environment where we want to focus on carry. It's very hard to predict where interest rates are going to go. Certainly in an environment where interest rates have risen and maybe have stabilized, you could argue that depending on, what happens in the future and Fed policy and such, and maybe there's more interest rate cuts that you can make duration bets that you'd be more confident in. But at the same time, we've seen that that's been very, very difficult to do. So I think, you look at a portfolio like you're describing, which doesn't have that duration risk, but really just focuses on the spread product, right? It focuses on something that we can get your hands around a little bit more with fundamental research and due diligence, and earn that carry and be confident that's what you're going to get, and then lower that volatility component. So when you think about a portfolio that may be replacing a core plus mandate, which has a duration somewhere between like 5 and 6, depending on the manager, with a portfolio there's a duration of less than 1, surely that could get hurt in a rate environment. But also, this portfolio will be carrying a lot more as well. That kind of compensates you for that, and you'll see a volatility profile that I think investors will like. And I think you've seen that also, which is private credit as well. I think
Right.
volatility there is is kind of a feature of the asset class. I think investors like that. So I think blending those two things creates really attractive kind of outcomes that investors, I think, will gravitate more towards.
Yeah. Let's talk a little bit about private credit because it's constantly in the headlines, right? You constantly are seeing either some alarmist worry that it's a bubble or that it's the end of private credit
Hmm.
or whatnot. And it doesn't seem like when you look at the data that that's necessarily true, just in terms of the magnitude of where it is today. It's like a third of the leverage
Sure.
credit environment. So how are you thinking about it and when you hear all these headlines coming in and talk to clients?
Yeah, I mean, taking a step back, it's an asset class that I mentioned has grown rather quickly post-financial crisis. Anytime you see that kind of growth, there could be times where, you're more suspicious of the lending that was being done. I think, and that's also true, obviously, in public markets as well. We've seen that in the high yield market around energy, around telecom.
Right.
I think when I look at private credit and kind of narrow it down, and you touched on kind of the growth of it, I think that 2020 to 2022 period where rates were pinned at zero, there may have been some risks that folks were taking, both on the probably syndicated side and on the private
Yeah.
side, because we talk about First Brands and Tricolor. Those, First Brands is a broadly syndicated loan. It wasn't a private deal,
Hmm.
to be fair. Not to say there isn't, kind of trouble in certain private deals. But that's the period we're talking about, right? And we're talking about a period where rates were pinned at zero and there was a lot of capital coming in. So I think standards were lowered. And now you're kind of 5 years away from that. And that's usually when, you have to pay the piper, right? And these loans come due. So it's no surprise to kind of see that. It's no surprise that there's now differentiation, amongst BDCs, and who's doing credit well and who isn't. I think that's healthy for any asset class
Hmm.
to go through that period after, 15, 16 strong
Right.
years. And that's what it's going through now. But then at the same time, when you look at, where we are at this moment, and kind of a clean slate we talked about rates elevated, and that's really what, kind of triggered some of this, because you had your denominator of interest expense rise rather quickly, and companies couldn't cover that and they weren't hedged. And there was obviously some other things going on, but I think when you kind of put it all together, on a go forward, you can kind of model that base rate and model interest rate scenarios and lend at, attractive spreads over SOFR. And that's what's happening, right now. But there's clearly some things that need to be cleaned up from that kind of prior period of bad lending. So it's like a vintage, right? So
Right.
it's nothing, just like venture capital, right? You're going to have good vintages and bad vintages. I think the 25, 26 vintage is going to be very, very good. We'll see what happens, 21, 22, 20. Maybe some trouble there, but and we'll see a lot of differentiation. And I think an active manager that like us, who's just started a private credit business, I think we're doing rather well here, lending in what is, I think, a good period to lend on the
Yeah.
private side.
Yeah, and it seems like it coming back to the earlier discussion just around blending public and
Yep.
private, it seems like you are seeing more innovation across our industry and kind of the portfolio that you oversee that looks at that invests in
Mhm.
public and private. The innovation there is kind of having an investment grade or investment grade oriented portfolio that's offered in an interval fund structure. So you're giving up some liquidity in order to get that
Sure.
reduction in duration risk and sort of that higher return profile. Um, what's your view just on innovation itself around this
Well,
idea of
I
convergence?
like the innovation too, because you're giving up liquidity. But if you look at our portfolio, one of the, we're getting the weeds a little bit here, but one of the things in private credit is you can never really be fully invested, right?
Mm,
Because you have, something called like a delayed draw or revolver,
yes.
where that you're lending against, and you need to be ready to make that commitment at a point in time. Whereas our product, you have half of it being in public credit, steady state. You have the flexibility to be fully invested
Yeah.
because you have liquidity on that public side to draw on, and
Mhm.
earn that carry. So I think that's really attractive when you think about that innovation, right? So I
Yes.
think that's something to consider, when thinking about like an interval fund structure that blends public and private.
Right. I know you touched on this during your answer just around the private credit and kind of what the risks are there. If you're just kind of talking to clients and they were to kind of say, is there anything that keeps you up at night, or is there anything that worries you just about the credit markets, or how are you kind of thinking about managing risk, or how should clients, where should clients be like being a little bit more cautious right
Yeah, I
now? I
mean,
know you said you're kind of bullish overall, but
sure, it's always the unknown, right? We can always talk about the risks that are known. Usually it's the unknown that gets you, like a
mhm,
pandemic or something we're not talking about. I think what I said up front is true, that you're lending in a very tight spread environment. There are pockets of value. I think triple C, single B high yield's a pocket of value.
Yep.
But overall, mortgages are maybe a pocket of value, but overall spreads are tight. So you have to keep that consideration in mind. At the same time, like in fixed income, what matters is yield. So I think, in retrospect, when spreads were tight and yields were low, doing high yield deals or loan deals, at very low, kind of base rates, or zero base rate with low spread, that's very unsatisfying, to earn 3 or 4%. But you see, like a year like last year, I could have said the same thing. Spreads were tight, and then look up at every fixed income indice and it's earning between, 7 and 8, 9%. I think the same could be true this year, but I think you want to control your beta, because you're not going to have a lot more room for spread compression. You can't say the spreads can tighten. They've tightened to start the year, but like you're reaching a limit. And I think that's something to consider. Now, in terms of, kind of macro risks, to me this year, I'm very bullish on this year. It could be simply too much of a good thing. It's kind of, if you depending on, who's going to be the next Fed chair, depending on kind of if the fiscal plays out the way people expect, and most people think it'll be stimulative, depending on the rate market, do you lose the long end or not? If you're cutting into something that, is too good, and you may see, that, cycle kind of turn again of lending, and things get too tight or too aggressive. I think it'll take time to get there. Potentially like a second wave of inflation. I have inflation coming down throughout the first half of the year.
Okay.
I'm pretty confident in that. Some of the data that we look at, we think about rents, which is a big part of actual inflation data. Think about things like car prices. We think about wage inflation, labor market. We haven't talked about that yet, but it's pretty much at kind of stall speed right here. Not a lot of net hiring. So not a lot of wage inflation, but certainly that can turn in the back half of the year, and depending on, who the Fed chair is and kind of their reaction function to that.
Right.
You could have, obviously a tightening environment at that point, or you could have a Fed that ignores it. The flip side of it, not to make this an innovation conversation, is, we've seen good productivity data. Some of that could be AI, maybe not, maybe that's to come, which could control, kind of those inflation impulses, which would be a very positive thing. That kind of the 90s, right? So all those things are on the table. But to me, like you need something. Economies don't just tip over. You need some sort of catalyst, right? And usually that catalyst could be a Fed that's tightened too much. It could be an oil price shock. It could be a pandemic, which obviously we're not.
Please
no. But that's usually how it goes. Until then, I think you're in a pretty good environment for risk taking.
Right. Okay. I mean, final thought just around, again, investing in just broad credit. Like you mentioned, like we're investors in credit, and kind of thinking about private and public is becoming more and more just like one bigger opportunity set. For a portfolio like that, where do you see investors, or how much do you see investors allocating to that, or kind of how does that sort of fit into a broader portfolio, or even, for if you're talking to existing clients and kind of trying to wrap their heads around this type of a strategy?
Sure. So I think there's a couple ways to look at it. We touched on that core piece, right? Core total return, and kind of controlling your duration risk, a substitute for core, because you have an investment grade orientation here. The 50% of the portfolio is going to be above investment grade. There's also this idea that, if you look at the portfolio, we're not full on direct lending, right? Which is risky, right? It's a single B allocation. That's done very well over the years, but you're still talking about 9 or 10%. Here you have a portfolio that does maybe 30, 40% direct lending. So it's a smaller step out into private credit. And we've only talked about direct lending. Here you also have what we call, asset-backed securities, securitized products, and ABF that's blended together. That's a really attractive area of the market, and a growing area of the market. Actually, I think the next kind of wave of private deals will be on the ABF, ABS side. So we're approaching that from two angles, right? Our ABS business and the ABF business, of our sub-advisor.
Right.
And that, you can trade off there pretty effectively in terms of kind of spreads between the two. Just like I talked about in spreads between bank loans and direct lending, you can do the same on the ABS side.
Right.
Kind of be very active around that. And what's nice about those profiles, those generally tend to be IG profiles, where you're talking about CLO, even down in the mezz, you're talking about, a whole business deal on the ABF or ABS side. Those are all really attractive. IG profiles that give you much more spread than the average kind of US investment grade deal. US investment grade deal right now is probably a 75 spread. CLO AAA is 110 to 120, or, if you're going down into the mezz, you're getting, 200-300 basis points. Same is true on the ABF side. So that's really a really attractive area. That's also a big part of this portfolio.
Great. So some great insights here today, Steve, and definitely a conversation worth continuing in the future. Love to have you back.
Thank you. Anytime. I'd love to be back.
Awesome. And so we'll leave it there. For investors wanting to learn more about Lord Abbett's views on the markets, please visit the Insights section of lordabbett.com. And if you have any comments on today's episode or ideas for future episodes, please email podcast@lordabbett.com. This has been Brian Forster with the Active Investor Podcast. Thank you for listening.